I'm going to organize the screen here, and we will get started. Okay. Looks like I am somewhat ready. Perfect. Good evening, everyone, and thank you for joining this evening. Really appreciate it. I'm just going to make one quick comment. If you're listening to the audio recording, this is I'm recording this. It's probably in your best interest to look for the link and watch the actual visual video and not listen to the recording, although you can probably follow because I'm very verbal as well. So thank you very much. Thank you for joining me this evening. I'm going to be here for the next hour or so, spending my time with you, sharing the information with you about real estate investing. I'll introduce myself in a moment. Quick announcement. Everything in this presentation is based on actual life experience. Nothing is generated, no content is generated by AI or by someone else's experience. So just be aware of that. This is a real deal, trenches, investing, etc. And by the way, I'm going to be at the end of the session. You're most welcome to put your questions while I speak, and I'll try to tackle them. But what I like to do at the end of every session is actually, I call it the Q&C, questions and conversations. So not just opportunity to ask questions, of course, for me to answer with pleasure, but also maybe engage in conversations and different things that are directly related or not necessarily directly related to the to tonight's content. So hopefully we'll get that very, very soon. I want to mention that on the, the 25th of the month, so that's in about a week or so, we have another event similar to this one, but we have another component that it's not here tonight, and we're going to talk or introduce or share with you our turnaround program. The turnaround program is something that we are very excited about. It's how we came up with a plan to help certain, let's just say, people that have money, but not, they're on the verge of kind of succeeding or investing, and they're kind of a little bit held back, and they need the mentorship, and they don't have a lot of money, but they do have something. So we created this combination of investors, experienced investors, mentoring inexperienced investors through actually buying a property together. So that's something that's coming up that we call it the turnaround program. So more about it in the Q&A or on the 25th. It's free. You're most welcome to join in order to benefit from similar content for tonight, as well as the turnaround program. Okay, here's what I plan on covering tonight. I'm going to touch on a couple of things or many things, and I'm going to talk about some what I call the kind of different aspects that are maybe not that obvious for real estate investors related to obviously related to real estate investing, some pointers, suggestion, tips, emphasizes on how to succeed even better, and maybe kind of talk about common mistakes and risks, etc., that people tend to fall into when they're thinking about investing. Let me introduce myself. So my name is Dani Beit-Or. I have been a real estate investor since 2002. I actually started investing in US real estate when I was living in Europe, a young engineer living abroad, year 2002. 2002, Google was considered a startup. It wasn't as big as it is right now, of course. A lot of the technology that we have today, a lot of the tools, a lot of the information online, etc., was not around as much. So it was much more a very different investing environment, a very different investing environment for someone who lives in another country and investing in the US. So a whole different of tools and information and etc., and transparency and gaps. I call it the many gaps, the language gap, the time gap, the information gap. Oh my God, so many gaps. It's hard to believe it was even doable, but it was. I'm the owner and founder of Simply Do It Real Estate Investing Network. I'm based in Southern California, Orange County. I've been investing since 2002, but I've been helping other people, other investors to invest in real estate, I should say out-of-state real estate, since 2004. So since 2004, I have helped clients and investors buy in multiple US metros, in multiple states such as Arizona, Oklahoma, Florida, Texas, Arkansas, Alabama, North Carolina, Georgia, Idaho, Utah, Missouri, Kansas, Tennessee. I'm probably neglecting one or two here, maybe not. So a lot of activity, investing activity, primarily residential properties, primarily single family homes, duplexes, fourplexes. I've done other things as well, but that has been the core of my activity. Long-term buy and hold in different parts of the country. And to date, I've helped, investors acquire something around 5,000, probably a bit more than 5,000 properties in the spread of 20 some years. So everything I like to do when I speak, like tonight, when I prepare any presentation, I always try to make sure I bring valuable content, real content from experience, and not just theoretical or something that I know nothing about. I don't like to speak from lack of knowledge. I like to speak from position of information, experience, and knowledge. I want to start off by saying, maybe I should say, first of all, happy Fed's Day. We had a good announcement, or interesting or exciting announcement today, that the Fed announced that they're going to drop the interest rate by half a point. That's exciting. I think my bet it's going to go down, but a quarter point. So it was more than I expected. But I really want to put, this idea, this conversation a lot of us are having around interest rate, or what I hear a lot, obviously less now. The interest rate is very high. It's hard to buy. I want to put it really in perspective, right? Because this is something that I've been hearing for the past, I want to say, a year and a half too, when the interest rate went up. And let's just think about it for a second, right? So a lot of people are saying, or a comment that I hear a lot, I'm not buying anything right now, or I'm not sure I can buy anything because the interest rate is high, right? For me, this is a very, very blank statement. It means nothing. What does it mean if the real estate is high, right? I understand when we are accustomed to a lower interest rate and now it's higher, it's high, but many of us, when we really think about it, we just stop by saying the real estate is high and I'm moving forward, I'm doing nothing about it, instead of understanding how to process or how to comprehend or how to factor in the current interest rate, whatever that interest rate is, into your investment journey. So when you tell me, when I speak to one of you or someone like you, and you tell me the interest rate is high, I want to know, high relatively to what? Is it relatively to the 2.75 or 3% that we've seen during the COVID and post-COVID era? The answer is yes. Of course, it's relatively high to that. But is that a real number we can compare to? Because during the COVID and post-COVID period, interest rates were extremely low, and this was a fluke. This was unprecedented, right? This is not what normally, and you can see here between 2015 to 2024, where is pretty much the interest rate somewhere between, let's just say, around the 5-ish, give or take, for the most part, sometimes below 4, above 4, 4.5, 5, and above, right? So when you're comparing the interest rate today to whatever it was back then, it's irrelevant, because that is not something that we can really use, because that was a one-time kind of a thing. So let's compare your real estate to something more realistic, right? Let's say in normal times, when it's not crazy COVID, interest rate for real estate, real estate or real estate investment, let's just say it's 5%, right? So if now today we are at 6% and normal times are 5%, even 4.5%, is that a real problem? Is that something that you cannot digest or cannot include, in your investment? So in my opinion, you can and you should, or I should say, it really depends on what you're doing. Because I can tell you, for example, that I had a property that was probably 7 years ago when interest rate around me was probably, I don't know, 5.5, 6, and I bought it in a certain situation with an 8% interest rate. 8% was relatively high to what was available in the marketplace, but the deal made sense, right? The way the deal was structured, the way that I was able to buy to acquire these properties, the way that there was other things related to the property that made sense, 8% was something that I was willing to take because it made sense in the bigger scheme of things, right? So 8%, for example, in times that around me everything is 2% less, it wasn't not something that I was enjoying, but it wasn't terrible. So really think about your interest rate, how it incorporates into your financial decision, into your investment, instead of thinking about it as a high, low, in a very absolute number, right? It's relative to what? How can does your investment, can the investment handle that? This is how I would probably consider the interest rate. And let me give you an example how it can be, on one hand, not too terrible, and on the other hand, maybe a little bit more challenging. So here I am, I took two mortgages, two loan amounts. One is a 200,000, the second is a 500,000. Let's focus on the 200,000 for a second and see what is the monthly payment when we have 6% and when we have 5%, right? 1% interest difference. And when we have that, we can see that the monthly difference between those two is $125, right? $125. Now the question is, when I'm doing and when I'm about to invest in the property, between those is the investment, can the property I'm buying handle the additional $125? Now, would I rather it's not be there? Of course, but it is what it is at the moment. Can it work still with 6% versus 5%, right? So that's obviously on the $200,000. If we translate the gap, the difference, then it only brings us about $125 difference per month. So remember, it's not just about the rate, it's also about the actual dollar value, because on a 500,000, right, the difference between the 5 and 6% interest rate adds up to about $300.15 a month, and that can be obviously a much bigger difference. Now, it could be that in this case, when we are considering the cheaper mortgage, the cheaper property with the lower mortgage, $100 and change is something that it's easily digestible by the investment. But with a 500,000, maybe we're already tight on the cash flow, for example, or the expenses, and it will be more challenging to give up another percent from, instead of 5-6%, and the deal is not going to be as attractive, right? So really put it in perspective. Don't just, I don't understand the concept of it's high, it's low, it's in context. It's got to be in context. It's got to be in relatively to what. And the other thing I want to mention when we're talking about interest rates is it's also important to keep in mind what you believe the interest rate will do, right? We don't know, but if you have a belief system that it will continue to go up, and right now it's at 6, and in 1 year it's probably going to continue going up, then maybe it's actually lucky to lock it at 6% and be happy with it. But if you have a belief system that maybe in the next year, 2 or 3 or 4, it will go down even 0.5% or a full percent, then maybe you can look at your investment and saying, you know what, in the next, let's make an assumption that in the next 4 years, I'm going to be at a 6% interest rate. But somewhere in the next 4 years, if you believe that's the case, you think there's going to be an opportunity to lower your interest rate to 5.5 or 5%, 5.25, right? So that means that if you think that opportunity will present itself, then you know you're not connecting yourself, hitching yourself to a 6% for life. You're only hitching yourself to a 6% for the next 2 to 4 years, with hoping, right? Planning, assuming that that opportunity to refinance will come, in the let's just say the near future, and then you will refinance, right? So put in perspective, it's really important, instead of just saying high and low. And by the way, just today I had 3 conversations with 3 of my clients. All were kind of reaching out to see, should I refinance? Because right now, interest rate today is probably around 6 on a refi, 6.1 ish, depending on a few factors, obviously, but let's just say around 6.1, give or take. And we were looking at 7.1. It was a more obvious opportunity to refinance, and even a 6.85 or a 6.8, 6.785. And we still thought it would be a good opportunity to refinance. So here you go. We have clients that we evaluated this week, today. Should they refinance when it's not even a full percent, which is, by the way, the cost of refinancing will probably justify, the difference in the monthly payments within about 12 to 14 months, based on the information, we analyzed a few hours ago with some of our clients. Okay, let's move on, or at least try to move on. Okay. Perfect. All right, now let's talk about why out of state. And you know what? I think that, sorry, something is blocking my view. I want to maybe take a second here, and if you don't mind, typing in the chat, where are you from? Like which metro, which area? So at least I have a better understanding, who am I speaking to? So if you don't mind, just putting in the chat, I don't know, I'm from Seattle, I'm from LA, New York, whatever. Charlotte, perfect, excellent. We got one. And for some reason, yeah, Irvine, hello, neighbor, perfect. Fullerton, hello, another neighbor. All right, perfect, thank you. Okay, so probably a more obvious conversation, or more trivial conversation with someone who's living in California than someone maybe in North Carolina. But let's talk about the concept. It could still be relevant for other parts of the country, but let's talk about why I like buying out of state. And I've been doing out of state for 20 years. I don't know what in state even looks like, right? So I've been doing all out of state. So why would I consider it, right? So we have the obvious reasons, like diversifying. Maybe we're centered in one area, depending on one local economy, California, Southern California, Orange County as an example, and we want to diversify to other geographies. Okay, makes sense. For me, it all starts with a couple of things. First of all, it really depends where you are, but if you live in an area where, let's just say, I'm going to pick on the person from Charlotte. Let's just say if you live in an area that numbers still make sense in your immediate 30, 45 minutes, the purchase price, the rent, maybe you can go and get 1 or 2 more percentages, or $100 or $200 more in rent if you go to another state. But it's not always just about moving to another area. For me, or completely out of state, or completely out of my immediate geography, for me, it has to be significantly appealing. Because when as someone from California, when I go out of state, obviously I'm working, or I'm banking on the geographical arbitrage that happens between expensive real estate market like California and other parts of the country, and cheap rents relatively to the cost of the asset, comparing to other parts of the country where the real estate is relatively cheap, right? Significantly cheap than here for similar properties or quality properties. And the rents are relatively high, right? Relatively high to the cost of the property. So for you guys from Orange County, let's just say we look at something at $1 million, 750,000, right? And then we rent it for, I don't know, 4,000 to 6,000, give or take. For $1 million out of state, I'll probably buy 5, maybe 4 properties, and the rent on those 4 properties will probably be around close to $10,000 ish, maybe even a little bit more, depending what I'm buying. I could probably optimize it a little bit. So that means on the same on the same asset, I'm almost going to double the rent, which will dramatically impact the cash flow, right? So that's the whole purpose, the whole point. On the top of that, if you live in some states that the laws are, let's just say, landlord or tenant friendly, and considering investing in other parts of the country where the laws are more landlord friendly, that's definitely another reason to consider that. If you live in an expensive area like the Orange County people here, like myself, to buy even a $750,000 property, you need a larger amount for the down payment. Maybe you don't have that amount. Maybe you do, but you don't want to put it all in one asset. So going out of state will significantly reduce the amount you need. So that can be literally a go, no-go situation, right? You may not have enough to buy locally, but enough to go and buy out of state, right? So it's a lower, could be a lower barrier of entry. So out of state comes with challenges, and we're maybe going to talk about those things if we have time during the presentation or in the conversation afterwards. But it starts with significant financial differences, right? The cash flow, the rent, altogether the cost for buying a piece of property. Let's talk about something that I see investors do not always factor in when they are starting their journey, with investing. So it's all. Let's talk about the commitment. What is required? Time commitment and other commitment, right? So when we talk about mostly time commitment is really relevant to the type of investment you are conducting. If you're flipping a property by yourself, it will require a lot more time, attention, of you being on the ground or on the top of things. It's a project management. It's not even an investment. It's a project management. It's a job in a way, even if you do it on the side. So on one hand, right? If you're investing in a syndication or a fund, someone else is running the show, and you are what's called almost passive investor, then it will require very little time on your behalf on the day-to-day. So it really depends the type of investment, but you're probably looking at 2 aspects of time management, time commitments. One is when you're making the decision about what to buy or what to invest. Is this a good property? Is this a good fit for you? Property or setting or company or operator, right? You're going to spend significant, I want to say a significant amount of time, concentrated amount of time, I should say, just to make a decision about an investment property, or that decision, you can still make that time investment into making a decision, only to realizing it's not a good fit and not conduct that, right? So there is the initial time. You should ask yourself, do I have the time right now to review with Dani's team properties on a weekly basis until I find the most suitable rental property for me, or not? Maybe you're too busy between work, family, traveling, whatever, right? Maybe you're not, and you really need to find something that will require very minimal investment to just decide what to invest in, Once you own that investment, then you should ask yourself, how much time will I need to be actively involved, right? Remember, nothing is fully passive in order to oversee what's happening, right? So if you're, again, a busy person, every once in a while, I get people who come to me and say, you know what, Danny, I like, you seem a nice guy. I like your operation, your idea, but I'm really busy. I don't have any time, right? Any time, like really any time. And then I always tell them, like, if you have no time reviewing properties with us and making a decision for your sake, and then spend that on average an hour a month just making sure everything is okay with your asset, with your portfolio per property, and 1 hour per property, then probably it's not going to be a good fit, right? We are not set up for this. Some other type of investments are, we are not, and I'm going to politely tell this person it's not a good fit, because we do need you, or expect you, or think it's the right thing for you to be involved in making a decision. We're going to help you, but you're the one who needs to make sure you're comfortable with that investment. And then when you own that property, things will come up. It's vacant, there is a repair, you have to approve this, etc. You got to be available to make those decisions. It is in your best interest. If you're completely busy, you don't have time to this, what we do here is not going to be a good fit. You need to find something else that will require very minimal time to decide and very minimal time on an ongoing. And those, it's like something like a stock or a fund or a REIT or those things, do exist, and where they will probably be a better fit. So always ask yourself how much time commitment, how much time I am available to invest to make a decision, and invest on an ongoing as long as I own that piece of property, as long as I own it. So. Okay. One of the things that I've seen over the years that, I get that question, I would say this is a common question I get every once in a while. If you're talking about out of state, do I need to travel in order to successfully invest out of state? Or can I not travel and still be successful? And I want to answer it in two ways. The simple answer from my experience is yes, you can buy, invest, purchase, manage, sell, right? Rental properties. I'm focused on rental properties without ever setting foot in that state. How do I know that? 95% of my clients, of Simply Do It clients, are remote investors that have never seen their properties and will never go and see their properties. That's just the reality. The nature of my business is that. Now, this is the simple answer and what I'm seeing happening in real life. Now, let me give you my full answer, or the answer I really like when people are using or utilizing. I do think you should. I do think you should at least once before you get started. Maybe go out, spend a day with if you go and work with us, with our local team in Nashville or in Kansas City or in Birmingham, Alabama, whatever. Meet the team, drive through houses, through communities, get away from the distraction, be focused on this, learn firsthand. You know what? When you travel anytime, you're not going to learn how a market behaves and operates, etc., within 1 or 2 days. It's just not going to happen. But when you travel, you are most likely to build up the confidence in the operation, in the area. You're probably going to go there and say, oh my God, it looks just the same to where I live, somewhat the same, right? Here's the Target, and here's the Starbucks, and Walmart, and Costco, and gas station, and here's a nice school, and a new nice school around town, and here's a hospital being built, and you know what? I think it's great when you travel, only to realize there are no surprises in a negative way, right? Just to find that, it's really good. You're not going to come back probably and say, oh my God, I fell in love with this area. It did happen to me once. or come back as long as you're not traveling to some really strange investment location, come back and say, oh, this is terrible. It's a swampland. I'm never going to invest here. It could happen, but not here, not with us. So when you do it at least once, you build that confidence, right? So that helps. If you do it every time before you buy, I think it will be very beneficial. You will gain knowledge, you will gain confidence, you will gain comfort about investing. And when things will pop up later on, you'll be a little bit more knowledgeable and experienced. So you're not going to learn the market, but you're going to feel comfortable in the market and know there are no surprises, right? So that's how I prefer people go, travel, see, check, visit before making a decision. I do have other investors that what they do, they're actually first looking at an investment property, second, making an offer, and when they get it under contract, that's when they actually travel, and usually it's within a day or two or three, to the property to meet the team and to be there during the inspection. So that's definitely an option to go and make the most out of it if you have that flexibility, and be there for the inspection, see the house, meet the inspector, walk the house yourself, meet the team, etc. So it's definitely two ways how I see my clients are behaving. There's nothing, there's no right and wrong. I think if you're asking yourself, should you, or if you feel you're obligated, just find what works better for you. Seeing the actual house under contract, or actually first seeing the area, getting to know the area, feeling comfortable with it, and only then, deciding on an investment property. But just to recap that, you don't have to. In Simply Do It, we are so used to people not traveling that we actually added more checks and balances into our systems and processes in order to add more transparency, cater to the way people actually, clients, investors of ours actually behave. So we added few more checks and balances in order to compensate for the fact that people do not travel. Let's talk about property managers, right? Property manager, I would say it's a very sensitive topic, right? So a very sensitive topic. On one hand, property managers have terrible reputation. On the other hand, if you really give it a thought, if you really think about it for a minute, and by the way, quick question to those of you who are engaging with me in a conversation here, I really appreciate it. It would be nice if you can share, tell me, do you have experience working with property managers or not? If you can answer either one, that would be terrific. I would appreciate to learn and learn for you. Is property manager a complete strange creature to you, or some of the things I'm going to talk about are actually things you are familiar with when it comes to property managers? So the question now is, do you have experience with working with property managers? While you're answering, I want to share with you what my experience and thoughts about this are. I've been working with property managers on a large scale for many years. When I say large scale, 20 years. Some of the property management companies we work with manage 80, 90, 100 properties of our clients. Some of them manage 300 doors plus, right? And our approach to working with our clients is that when you are our client, we continue to support our clients with issues that come up with the property management on an ongoing basis, right? So in simple terms, there is not a single week that I don't speak to at least one, probably more than one property manager on different aspects, normally specific situations that are taking place as we speak with one of the properties, right? If you want to know, as an example, at 10 a.m. today, I had a conversation on 3 properties that are vacant, and I want to understand better what's going on with the traffic. That just happened today. I had an earlier conversation with another property manager about a specific investment rental program we're looking into. We have another conversation with another property manager tomorrow, again, about a specific rental program as well. So that's just a regular week for me, nothing special. I'm sure there are more conversations with managers this week. So just give you an example. Now, With property managers, they are, you know, the way I look at property managers, that they are like firefighters, right? They are always putting up fires, right? Putting up fire, putting out fires. Either the property has a maintenance problem, or a turn, right, between tenants, or the tenant, there is an issue, they're late, they're upset, whatever, or the owner is upset about something, or the owner is demanding, you know, attention. I asked you 2 days ago for this answer, and it's been 2 days and you haven't answered me about something, you know, even insignificant, but it's important to that owner, right? So it's always that pressure and issues and problems. Like, not all the properties all the time, but you know, it is. So property managers, I just want to say, I really don't know who wants to be in that position, right? And if someone is a property manager, I'm just gonna say kudos to you. It's amazing. You're always on the defensive. Now, we at Simply Do It, I spend hours, many hours, just searching for the right for a good property manager in any area that we work with. Right? So I go through a process of vetting them carefully. I call it an interrogation until we decide who to work with. And I already know whoever I decide and work with, it's not going to be perfect. There's going to be inefficiencies. There are going to be problems. There are going to be issues, right? I know that. So some of the ways I teach my clients how to deal and work with property managers. And remember, when I come to a property management company, I come with a buying power. I'm going to negotiate better fees because of our buying power. I'm going to negotiate more services at either cost, something, or free, something they're not necessarily offering. Remember, there's more checks and balances that I'm adding to the process. I'm going to be more involved with them on an ongoing basis to make sure things are taken care of. So this is something we have high demands from our property managers, and I take my time to find the better ones. None of them are perfect, right? I want to make sure I'm weeding out the problematic one, the untrusted ones, the ones that without the proper systems and processes. But even when we find the good ones, if you are an owner of a rental property and you are not understanding that this is your investment property, it is not mine, even if you're my client. I care about it, but it's still yours. It is not the property manager. It's 100% yours. And if you're going to be sitting there and just hoping everything will be fine, if you chose a good property manager, it will probably be fine. But if you understand that it's in your best interest to follow up, to monitor, to supervise, to check, as if this is your asset, then you will benefit more. So my philosophy, those who nudge and those who are involved with their properties will probably get better results or better attention from the property manager, resulting in better results with the property, just simply put. So supervising the property manager like an employee, it's important, right? Understanding there are going to be mistakes, there's going to be miscommunications, there are going to be good intentions resulting in not the ideal outcomes, you know, will happen, right? Instead of being upset, right? Being upset, be more ready for it. Then it will reduce the chances of issues and problems. The way I approach the whole concept of working with property managers is I try to set the relationship up for success. And why do I say that? Because if I'm gonna check and look and keep looking where my property manager fails, I'll find many places. You told me it will cost 500 and it ended up being 550. Why didn't you ask for an approval on the 50, right? There are probably good reason for it, but just to be on the looking for the problem. 2 days ago, you told me you'll get back to me in 3 days ago, you told me you'll get back to me in 3 days, right? Why didn't you get back to me? That's very common things, right? So if I am like this, I'm always going to be upset, disappointed, frustrated, etc. However, if I tell them, hey, next week or last week we said something and I want to make sure it took place, it was repaired or fixed or whatever. And I'm not trying to be like, here you go, you failed again, or you're disappointing me again. I would probably have a much better relationship with my property manager. If I remind them to do something that I need them to do, although it is their responsibility to take care of it or to do it, and I just remind them of that, I'll probably have a better relationship and better results. So keep that in mind. Now, I do want to say, kind of as a side note, well, I've been working with property managers for 20 years on a very large scale, right? You want to ask a question, Mike?
What?
Do you want to ask a question, Mike?
Hey.
Yeah, we'll just go.
No.
Mike, sorry, I muted you, but if you have a question, you can either type it or come on back. There was some background noise. I apologize if I'm being rude. I just want to make sure. It sounds like it wasn't your intention. As a side note, after 20 years, I decided as of 2024, and we are finally up and ready and started in August, to create, build, set up what I call an alternative concept, an alternative system to property managers to manage your properties. And it's more dependent on owner manage and not property manager manage. And we created this ecosystem of service providers and technology and specialists. We've lined up different specialists from leasing to maintenance in order to have an alternative way to manage properties. And it's mostly, we call it Resi, and we just launched it in August. And I decided to offer, I'm not stopping to work with property manager. I just know that a lot of my clients have told me, if I'm already so supervising or so OCD or so actively managing my properties, I might as well do it myself, but I don't have the proper systems and processes in place to do it successfully. That's why we decided to create it. So as of August, we launched a whole new alternative ecosystem to managing properties without using the traditional property manager function, but supplementing it with specialists that will close the gaps that are created when you remove the property management or the property manager function. So just FYI, exciting things are happening here. At least exciting in my book. Okay, going out of state. Let's talk about some indicators, something that it's important to see. So I want to talk about, first of all, for me as a survivor or a graduate of the 2008 crash, I have been an investor before, during, and after the 2008 crash. And I was not just an investor, I had many properties myself, and I was also going through whatever we were all going through back then with my clients, right? One of the things that I've learned well during the crash, and that's like built into my DNA now. Yes, location is important, and that's maybe part of it. But for me, resilient is super important. When I say resilient or resilience, I'm talking about the metro. I like to go to metros around the country that are, first of all, have the resilience of withholding, surviving the next downturn, right? And when I talk about resilience, here's a couple of things that I want to make sure exist within a metro. Number one, what is the population size of the metro, right? I like to see at least 1 million people population-wise, the metro, not the city. I prefer to be in a 1.5 or 2 million people population-wise, right? So 1.5 or more, that's for me a good starting point. Anything below that, I'm a little bit more hesitant. There's got to be other good reasons why. Second, I want to see that there are big metro. I want to see there are multiple employers, big employers, and ideally representing multiple industries. So they're not all from the banking industry. They're actually different employers representing different industries that create the resilience that I'm looking for. Then I want to see that this metro is on on the receiving end of the migration patterns in the country, right? We do have migration patterns in this country. Some metros, some areas are more shrinking, some are more growing. I want to be on the growing side of those metros, so that's really important. Having growth is actually bringing more future buyers and future renters and helping rents to continue going up and values to to continue going up. So migration patterns are important. Population size, employment, employers and employment type, those are really important factors. Of course, numbers. What can I buy a nice property for? How much I can rent it? Do the numbers work, right? All those other parameters are great, but if I'm ending up I'm just going to pick on Austin, Texas for a moment, and we all know that Austin, Texas did very well during in values in COVID, but right now you're probably going to buy something for reasonable for $450,000, and it's going to rent for not even 3,000, right? I want to say that's not really attractive in my world when I can drive up the road to Dallas and I can spend on a similar house, I can probably buy it for 350, maybe 400, or maybe even closer to 300 and rent it for 22, 23, 24, $2,500 or so. That's a much better, a much more financially attractive. And I'm still, by going from Austin to Dallas, I'm living a 2 million-ish, maybe 2.5 million-ish metro, ending up in a tiny metro of about 8 million people, 7.5, 8 million people, maybe more. So just to give you, an example why I haven't been excited about Austin as an investment for many years, but I've been very excited about Dallas, exactly for those reasons. So just give you an example how those areas are similar in many ways, not too far in many ways, but completely, in my opinion, different world of resilient, right? Resilient in terms of investment. By the way, we're seeing it right now. Austin is going through correction after the COVID celebration. Last thing I want to say, I call it an important secondary. What I've learned over the years that I like to be in markets, metros that do not have what I call severe or harsh winters, right? Harsh winter like the Northeast or the North Midwest. So I am in areas around the country that definitely have winter, that some of them even have snow, but all those areas, I would say, when they do have snow, it really doesn't accumulate. It doesn't, build up. It's more like quickly disappear, and it's not necessarily snowing for so many weeks during the winter. Now, why do I want to avoid those areas with harsh winter? Well, as an investor, I'm probably if I'm in a harsh winter area, and if you are, and it'll be great if you are, and if you want to share with me something similar to what I'm about to say, I'll tell you this. First of all, there's a very good chance that in the middle of the winter, your house, your property is vacant. And for one reason or another, the heater fails and it's vacant. And guess what? Guess whose pipes are now bursting or frozen or whatever? And yes, even if we have insurance, hippie, that's not exciting. We have to deal with it. It's a hustle, it's trouble, and maybe it's creating a lot of damage. All right, not a big fan of that situation, which is Murphy's Law, probably going to happen. The second thing you're going to face in a harsh winter is that you will see that it's much more difficult to either sell your house in the winter or lease your house in the winter, right? So that's something I can tell you. I've been to those situations. However, I never had that problem of selling or leasing a house in the winter when I did it in Florida, right? The winter, the weather patterns did not impact my ability to sell or to lease during the winter because of obvious reasons. So for me, this is a secondary point, but I really consider it as an important one. I'm an investor. I am not in love I don't fall in love with a metro, right? I do have preference. I do have likings to one way or another. I like Austin as a place, not as an investment, as an area to visit, beautiful, no doubt. But as an investment, right? Can I go to other parts of the country that can benefit me better or have better resilient factor or would likely not put me in a more challenging situation like a harsh winter? Of course I do. There's nothing said that I have to go to Chicago because, I don't know, whatever. So just giving you an example. And by the way, I want to pause for just one moment and just say, you are most welcome to ask questions while I speak. If you don't want to ask questions or you want to maybe put your, write it on the side, I'm going to be done in a few minutes. You can definitely have, we can have a conversation on things that I talked about, things that are related to real estate investing. Probably not going to spend much time or share much if it comes to politics or sports. But if we keep it within the real estate world, what I like about those webinars or those sessions is that we can have a conversation, not just a Q&A towards the end. So keep that in mind when you're if you have those questions. So let's talk about common mistakes here for a moment. Mistake number one that I see it a lot, is focusing on the cash flow, right? And I'm not saying cash flow is not good. I like cash flow. We all like cash flow. But focusing on the cash flow is a challenge, or not a challenge. I think it's not the right thing to do. What I like to do is this. I like to look at, I call it the 3 growth engines, the 3 vectors of a property, maybe income streams of a property. One is the cash flow, right? What is the cash flow? Rent comes in, expenses, we have expenses, property taxes, insurance, etc. Maybe, probably if we have a mortgage, then a mortgage payment, etc. And the cash flow is what's left, right? So I like cash flow. Cash flow is important, but it's not the only thing. The second thing I like to look at is appreciation, but I want to look at this one carefully, because when I measure appreciation, and I've been factoring in appreciation, I use it responsibly. I don't use whatever the market is doing right now or what it did last year. I'm just saying, when I am considering somewhere around the normal inflation of 3.5–4% on average per year, usually if I hold the property for many years, let's just say 5 to 10 or more, right? At least 5, but ideally 10 or more, then very likely that the property will at least keep up with inflation over time, even if it has a dip of a financial, downturn in the middle, it will hiccup and continue. Guarantee? No. Is that what's happening in this country for the past 70, maybe 80 years? Yes, right? Even when we went through a dip, right? So when you hold it long term, you're kind of hedging against, a short period of a downturn, and you'll come out on the other side. How do I know it? Well, let me give you an example. One of my properties that I purchased 19 years ago, September of 2005, in East Orlando. That property, when I purchased it for $180,000, I can't remember if it was 177, 188. Let's just go to 180,000. In 2009, during the crash, it hit bottom, and it went from 180,000 to 84,500, less than half, right? Less than half. Not fun, guys, not fun. But I told myself, suck it up. You bought something for the long term. Be patient and wait. Now, is it 350, 355, 360, depending on, how Zillow feels on a certain day, give or take 350. Okay. So it definitely went from here, went down dramatically, slowly start, climbing up. And today it's worth about double, right? 20 years. It's not an exciting story, but it's not a bad story. And it was rented all the time, right? It's this house combined in the past 19 years. This house has been vacant in total 4 months in total. And out of those 4 months, I'm to blame for one of those 4 months, one of those months out of the 4, because I took the time to kind of freshen it up, clean it, and then do some stuff to it in between tenants, right? So I held it off the market for probably another 1 more month just to take care of it. So just an example. So cash flow is one. Appreciation, and I use carefully. I'm not saying, some people say I can't build on appreciation. I say between ignoring there's an appreciation and assuming there's going to be 8% annually, how about we use 3.5%, 4%, right? Just somewhere comfortable, right? Careful, cautiously. And the third is, return on equity, right? When we have a mortgage and we have a cash flow after mortgage payments, that mortgage payment includes principal and interest. So that means every year I'm paying down the principal. That, appreciation and principal reduction are not dollars in my pocket, but they are dollars in the wall of the property. When I sell or refi, I'll meet that equity. So I factor those three things in, and that's how I look at an investment property. So investment properties are financially, I look at the numbers, the cash flow, the appreciation, and the principal reduction as a return. But I also obviously look at other factors. So for example, let me give you an example just that we are working on as we speak. We have one of our clients, he wants to sell one of his, there's an HOA situation that he just had enough, he doesn't want to deal with it. On a duplex that was built in 2001 in a good part of Kansas City. He wants to sell it, right? He's willing to let it go probably 40 to 50,000 below market value. It's fully rented, but the cash flow is tight. The cash flow is basically breaking even, maybe even a tiny negative. It's actually a small negative, but if he refinance, and I told him you should at least refinance to a lower rate, he will go from a small negative to a small positive. And if he could do, I told him he can do a few more things in order to change it around, to a better positive. This is not a cash flow deal. It could generate a small cash flow if he makes those changes. It is not an amazing cash flow deal. But buying in that part of town, $50,000, let's just say $40,000 worth of equity, that's for me something I would like to on a quality property, definitely something that I would consider valuable, even if the cash flow is not amazing. The cash flow will come. How would I know the cash flow will come? Well, most likely with making some changes on the shopping for better insurance, lowering the interest rate, trying to lower the property taxes, maybe doing some changes with the management, right? And letting the market, take its turn with the rent. Slowly, this property with a small cash flow will turn around and become a nicer cash flow while it continue to appreciate. No guarantees whatsoever, but just an opportunity. So if you focus only on the cash flow, you're missing many other aspects of an investment property. Second thing I want to mention is a lot of investors are very techy. We all are, right? And what I mean by that is we sit or stand in front of our computer screen and we are looking for answers as if all the answers are on Zillow or Redfin or whatever website we're searching at the moment, right? The answers are there, but not all the answers are there. And if you don't know to step away from the screen and maybe pick up the phone, right? And call, that's me, I'm old school, or at least communicate one way or another with the local team on the ground and ask questions, and I'll get to that in a moment, about an investment property, you will probably miss on important, valuable information. Let me give you one example. A few years back, our agent in the DFW area calls me up and said, Danny, I have a property in this community in North Fort Worth that I'm super excited about. Let's find someone quickly. It will not last. I'm telling you, it will not last, right? And he says, I've been watching and waiting for the opportunity to buy in this community because I know how desirable this is. And if we don't move quickly, someone else will take it, right? One of my clients, I send it out to our list. One of my clients calls me back or looks at it, calls me back and say, Danny, I got to ask you something. This property, they're asking, I think at the time, 335. There is another property less than a mile away. It's almost identical, right? It's almost the same size. It's almost the same spec, almost the same age. Unbelievable match, right? About a mile apart. But they're only asking for 315 over there, and this is 335. It's $20,000 more. Why would I not buy the other one? Say, you know what? Let me check. I'm not sure. Good question. I talked to my agent and he says, Danny, listen, I've been watching this community. Houses in this community do not sit. They're either, if it's up for sale, people buy them quickly. If it's up for lease, they are leased quickly. It's a very desirable community, one of the most desirable community. I'm shocked that they are even asking for this price. They could easily, or should, or maybe they're just ignorant, ask for more. I'm telling you, it's a whole different community and area and location compared to the other one. There's nothing wrong with the other one, but this is by far better, right? And when we had that conversation, obviously, we were able to understand why the price difference. And guess what? That property was purchased. So just to give you an explanation why it's so important, not just to be on the screen, look for the answers, and hope we'll be able to make a decision, right? Find a way to communicate with your people in order to make better decisions. Last thing I want to say about common mistakes. If you are not in the habit or have the skill to know to ask good questions, you gotta change that. It's a life skill important, not just real estate important, right? And when you have that ability, and that will service you, that will help you tremendously. And how can you change that? Well, the only way, I think I personally was always good about asking questions, but I never know if it's me. How can I know if I'm good or okay or whatever? But I can tell you that years back, I started from, probably before every significant conversation I had, I took my time, I wrote my questions down, and I came prepared. By the way, I still do it to this day. I came prepared, right? I came with questions, and then I sometimes even organize the questions in a way that I can ask the same question in a different way to see if I can get something else out of the conversation, although it's a similar question. I taught myself to be even better about asking questions. If you are good about asking questions, you will progress you will be able to advance your whatever it is you're doing, investing or something else, tremendously, right? So if you're not good with that, start making those changes, small changes, improve your asking questions skill or ability. It will advance you tremendously, not just in real estate, right? So learn to ask questions. I think it's a really important skill. I'm saying it because sometimes people reach out to us and they say, I'm interested, or they barely ask any questions about they say, what do you think about this not even asking a question, like, can you tell me more? Can you tell me more about the property? You just received an email which is 2 pages long with information. Be specific, right? Progress, advance the conversation. Okay. I hope, investors many times buy by themselves, or loan operator or lone wolf, or however you want to call it. But sometimes joining a large group can benefit you tremendously, right? And why do I say that? And when I say large group, it could be someone like Simply Do It, like ours. We are a large buying group, but it could be other ones, right? It could be in a different category of investing. Let's just say, I don't know, short-term rentals, right? Which we don't do short-term rentals, but maybe you join that group. If you join a group, they'll have systems in place, processes in place, teams in place, tools in place, buying power in place, so many systems, processes, expertise, etc., that can benefit you. So for me, it's like we are laying down the tracks. You can probably just jump on and use them, utilize them, benefit from them, so you can actually do better. So that's simple as that. So joining a large group can benefit you quite a bit. Having someone you can talk to, consult with, get guidance, get support, all those things, I mean, that will save a lot of time, energy, etc., and can help you quite a bit to be more successful, more efficient, no doubt. This, Simply Do It is my company. We focus on mainly long-term residential rentals in multiple US metros, right? At these days, mainly in Greater Nashville, Kansas City, St. Louis, Missouri, Birmingham, Alabama, Tampa, and Orlando in Florida. We do have some activity these days in Houston and Dallas-Fort Worth, not much, because we're mainly seeing sales happening there and not purchases, right? So definitely have teams doing stuff. I purchased something outside of Dallas about 3 weeks ago. So there is activity, right? Over there, less so these days. Now, we do have the traditional long-term rentals. That's our main program. We also offer hybrid rental. It's where hybrid rental is a combination of using mid-term rentals as well as short-term rentals, right? But primarily the mid-term rentals, and I can elaborate more on that if anybody wants when we get to the Q&C. We have the turnaround program where we help. It's more of a social impact program where we help investors or investors want to be on the verge of investing and they are a little bit, maybe a bit tight on funds or need some more mentorship. So we have that too. That's called the turnaround program. Co-ownership is when we bring investors together to co-own 2, 3, 4 investors to co-own a rental property together with a professional operator that takes care of everything. So that's another program that we run. Resi is our new alternative property management or asset management or portfolio management ecosystem, right? And those are the main things that the main programs that we have here at Simply Do It. We also started what we call the Wealth Partners. We just start lining up in the past year many service providers, from inspections to insurance to financial services to other companies that provide renovation and tenants turnaround and others, in order to use our buying power and provide access to other services that are relevant to our industry, to what we're doing. So we started this Wealth Partners. So those are, I just had a conversation with another one just before we got started. Those are functions, companies, organizations that can help you propel, right? Those are not necessarily real estate providers or generators of investment opportunities, but more the services around succeeding with your owning and managing and doing better, right? We have a whole list of service providers throughout the country. This is just to show you where we are operating these days. All the blue markers are representing flip properties that we used to do. We don't do that anymore. The red ones are representing long-term traditional rentals, and a new color is coming up probably within a week for the hybrid rentals. Here's some information about our resources that you can find out more videos on YouTube. I have a lot of them. We have a podcast that you can benefit, listen, learn. We have properties that can check that we upload on a, I want to say, weekly basis on our website. So here's some additional information. And I do want to offer a couple of things just before we wrap up. I'm not going to sell you anything. I just want to offer you a couple of things. So first of all, if you're interested, I have an ebook that I'll be happy to provide you as a gift just for appreciating you spending this evening with me. My ebook is easy to read, all based on experiences, definitely dives more into different aspects of things that we talked about, related rental properties, and I have a whole chapter on fourplexes, a whole chapter on working with property managers, etc. So if you want to receive my ebook, you can just go to, if it loads, I don't know why it's so slow right now. Finally, you can download it for free, no problem. You just go to simplydoit.net/ebook. Simplydoit.net/ebook. If you want to meet with me in person being literally, those of you who are local to Orange County, on the phone, Zoom, whatever you want. Usually we do 30 minutes, free meeting. It's not even consult. It's more, opportunity to see what's bugging you, concerning you, questions that you have. It's kind of open conversation, not a sales pitch. We don't offer an investment boot camp, or we're not gonna sell you anything. For me, it's an opportunity to have a one-on-one, more intimate conversation with you. Always, I've had thousands of those conversations, literally thousands of those conversations. People come and say, well, I have a specific situation. I'm not sure. I'm selling a house. I'm not selling a house. I have a 1031 exchange. I'm considering this. I own this. I'm selling in another country. There's always something. I have this concern, that concern. I'm not sure about something. I want to run it by you. All right, perfect. Let's have this. We call it a strategy session. I actually changed its name recently to welcome call. No sales pitch. If you're interested, usually 30 to 45 minutes. I don't stand there with a let's go. It's a very easygoing conversation. You're most welcome to set up a time by ideally going to our intake, completing maybe 3 minutes to 4 minutes of your time, a quick questionnaire. No social security, no personal questions, no credit card, no nothing. It's just something, that few questions that we're going to ask you that will help you and me to come better prepared to the session. So I found that every party that's going to either put the information or read the information, benefits from this intake, and we are coming to a conversation more ready, more prepared. So you are most welcome to register or request a meeting by going to simplydoit.net/intake. simplydoit.net/intake. And like I said earlier, we have another event coming up on the 25th of September. It's going to be similar to this one. Plus, we're going to talk about the turnaround program. That being said, here's my information. This is not me right here in the middle, but someone else. And I would like to open it up for questions. So if you have questions that you want to ask me regarding anything I talked about, something not directly related, you can unmute yourself. You can type it in the chat, whatever you feel like. That's quite all right. I'm going to wait here for a minute or two and let you. We already have one question that asks, where are we buying? I think I was exactly answering it maybe 3, 4, 5 slides ago about those areas. Right, you guys. I think this is a wrap. I want to thank you for sticking around. I want to thank those who are listening or watching the recording. You know how to get a hold of us. I'll be very happy to spend some time with you, to getting to know you, and mainly see if we are a good fit of working together. I want to wish you a good evening and enjoy the rest of your evening, the rest of your week. I hope to hear or at least see you guys very soon. Have a terrific rest of your day. Bye bye.